Hello and good evening, everybody. Welcome to tonight's program, How to Get an Extra Edge in Investing or Trading. So what does this extra means, right? I'm sure you guys are asking. But before I start, can you just say yes on the comment section if you can hear me and you can see me well? Just say yes. Welcome everybody to tonight's session. Thank you all for joining me tonight in this special session actually for you guys who are investors and also traders. Thank you. All right, thank you. Thank you, Himin Pang. Thank you, everybody. Okay, it looks like we're all set to go. Okay. Yeah, so once again, welcome to tonight's session. Tonight's session is also brought to you by Affin Huang Investment Bank, together with Affin Huang Capital. All right. And we're basically going to focus on market characteristics actually today to get an extra edge. I know some of you have already probably have a trading plan or investment plan or even strategy to invest or trade in the stock market, right? But sometimes we do feel that it's not easy to be implemented and because of price volatility, right? And we are sometimes get caught by this volatility, especially in this kind of times where markets are quite volatile at the moment, all right? So I'm just going to share with you what you can actually do, okay, to identify this risk further, okay, in terms of volatility, that you'll be able to understand the price behavior and, hopefully that you're able to make better investing and trading decisions. All right. Yeah, welcome Steve Chong, Jenny Tong, Arul, Lee Hong Seng, Raymond, Willie William. Okay, awesome. Now, please do participate in the polls that we will send you on your screen from time to time. Yeah, and also we'll give you a link later to download the slides if you want to download the slides for tonight as well. Okay, so just bear with me. In the next 1 hour, I'm just going to do a presentation. And if you guys have any questions at all, please just type in the comment section. All right. So let me just share my screen. Okay, so markets are even more jittery today, right? The index has came down. Most of the counters have actually come down as well. The only thing that's going up is the number of daily COVID cases. So hopefully you guys stay safe at home, and only go out when there is an important thing to do, all right, in order to curb this. If not, we're probably going to get ready for a total lockdown, which we do not want. All right. Now, so my presentation today is going to be how to get an extra edge in stock investing and also trading. So there'll be two examples. Actually, there'll be two things that we have to consider, whether you are a stock investor or a stock trader. Stock investing, that means you are buying stocks for the long term, all right, probably 3 to 5 years kind of holding period. And for trading, of course, it's for short term, right? So there's two different trading strategies altogether. So we're going to take a look at each aspect. Okay. Now, before we start, whatever that's being shared here today is for educational purposes only. It's not intended as any investment advice whatsoever. So if you want to look for an investment advice, please do look for a licensed investment advisor. Okay, so let's begin. Now, we all know that having an edge in investing or trading is basically having a strategy or a trading plan, right? Because without a trading plan, if you fail to plan, basically you just plan to fail, right? In the markets, it's like this, because if you just go in and to gamble and to just base your trading and investment decisions based on luck, then you're probably there to fail. Okay, but you need to really have a good investment and trading plan. Then you're able to at least keep your sanity, right? Because trading in the markets is very emotional. Right now, if you have bought stocks and the prices start falling, we just cannot get we get restless, right? When prices fall. Well, of course, when prices increase, we will feel more relieved. So in order to have our sanity in the markets, you really need to have a plan. So when you follow the plan, at least you have guide, right? And you know what you are doing. Now, having a trading plan or strategy, basically knowing exactly what to buy, when to buy and sell, and also how much to buy and sell, that comes in money management, right? So there are actually three components into a trading strategy. The first one is a trading plan. Okay, you basically use information or ideas or indicators, fundamental or whether technical, to get ideas when to get in and get out. All right, those are basically your trading plan. Now, of course, in trading, we also need to manage our money well. Okay, that includes how you manage your portfolio depending on your risk profile, and that will affect how much you'll be buying and selling. And of course, lastly, in a trading strategy, you also need to control your emotions. All right. Now, if you have a strategy, you basically have a slight edge against the market, right? Especially those who do not have a trading strategy or a trading plan at all. So you have a strategy, again, is basically just keeping you guided, okay, on investments. But having this is not enough as well, all right? Because sometimes, and if you ask any investor or trader, one of the most difficult part in investing or trading is to have the discipline to follow, all right? For example, if you have been investing, if you are investing in the long term, right, and your stock portfolio goes down 20%, okay, what do you do? Okay, although it's, because the price has gone down 20% and your asset has gone down 20%, we'll have this emotion, right? We have this feeling of asking ourselves, should I keep holding or should I sell? All right, although your objective is long term, right, but because of this price volatility in the short term, we sometimes get jittery, we get scared a little bit. All right, and that's what happened. Now, same thing with trading as well. The moment you buy, you expect price to go up, and the price don't go up, it start to come down. Okay, so what do you do? All right. So when it comes to trading in the markets, especially if you are trading with real money, it's a totally different ball game altogether if you are not trading with real money, right? Because trading is very, very emotional. Yeah, so Steve is asking money management. No, I'm not even talking about money management today, right? Of course, it's part of it, but again, I'm not going to come into the trading strategy because you can actually learn, trading strategy, whether from Equities Tracker or if you go and learn from somewhere else. But you need to have a plan, okay, to have an edge. But what I'm talking is this extra edge. Okay, so what is this extra edge, right? One of the things that we learn in the markets, and one of the things that in Equities Tracker we do not really believe is, we don't believe in stock investment gurus, where there's no such thing as guru, in my opinion. We continue to be students of the market, right? And if you have been trading 20 years ago, the market is totally different. The characteristic, the behavior of the markets is different from what it is today than 15 or 20 years ago. It's really different, right? So we keep on learning, all right? So we are still students of the market, and one of the things that we can do is we can actually learn from failures, in our own experience in the market. And once we learn, we try to avoid these mistakes from these failures. Okay, so one of the things, okay, there are many things that we can learn from our failures in the market, like having the discipline to follow, don't over trade and so on and so forth. But one of the major component in learning from one of the mistakes most traders do is the failure to understand a stock price behavior. All right, because this will actually determine whether you are able to follow your trading plan or not. Okay, especially in our markets where the prices are volatile, and especially if you're trading in more volatile stocks. Okay, so one of the things that we have to understand, that stock price volatility is different from different counters or different stocks. Okay, although they are fundamentally good to invest, stocks can be volatile as well. All right, so there are counters that are less volatile, they don't move that much over a period of time, but there are counters that can be more volatile. All right, it can fluctuate maybe between 20 to 30% in a week or in a month or even a year, where some counters, some stocks don't fluctuate that much, right? it's important to understand these characteristics of these stocks before you invest in them, so that you are able to manage your investment better. All right, so let me just give you an examples. Right now, let's take a look at the long-term investor point of view. So here you are making a long-term investment decision. Okay, I'm just going to do a scenario for you, a few different scenarios, and maybe you can identify yourself, because for sure I have gone through this experience, and and then we're going to learn from this and how we can actually mitigate the risk from this. Okay, so let's start. Right now, let's say you buy ABC share for $2. Okay, the price goes up to 240 after a month. So the price went up 40 cents. You'll be happier about it. Yes, okay, you know it's on its way to give you the returns that you want. So as if the price goes up where you're expecting, then of course you have this happy feeling, right? You don't have any problems. You don't feel jittery. You're not scared. All right. As the price continues to go up, and then 2 months later the price falls back to $2. Okay, and it's normal because you haven't not lose money yet. You are still in the money. It has gone back to your cost, so you don't lose money. So everything is still fine because your investment is long term, right? You're going to expect to see returns maybe after 2 years, after 3 years, after 5 years. So after 1 or 2 months, it's not really a problem. So 3 months later, the price went up to 280. Okay, and 4 months later, the price went up to 320. So it's going up. Okay, as long as the price goes up, you won't feel any emotions. Okay, you just go through a very good period. Okay, so for example, if you have been, let's say, buying shares last year, right, in March or April when the prices are low, you will not feel so jittery today. All right, but if you have bought stocks, let's say a month ago or 2 months ago, today you'll be a little bit jittery. You'll be a little bit more afraid because prices are starting to fall. All right, so I give you another scenario. Right now, let's say you bought a share again of DEF for $2. Okay, and then the price went up to 220. Right, so you feel happy again 1 month later, no problems. You remit 10%. The price is still going up. Okay, and then 2 months later, the price start to fall to 180. And then now we get a little bit afraid, right? Because now we are down 10%, 20 cents. And then be thinking to ourselves, just after 2 months, right? Although our investment is long-term, right? But after 2 months, the price come down and you get a little bit more afraid. And then we'll be thinking ourselves, what do I do, right? We have a gap here. We have this hurdle in front of me right now. But because my investment is long-term, so I decided, you know what, maybe I just hold, okay? And then 3 months later, the price went up to $2. Okay, not so bad. It came back to the cost price that you bought, investment cost, and you feel okay again, right? And then 4 months later, the price went up to 260, and he says, "You're lucky I didn't sell." Right? When the price came down to 180, I did not sell. I'm a long-term investor, and we all know that if you bought a good or fundamentally good stocks over the long run, the price should go up, right? And 6 months or 12 months later, the price gone up to 380, so it really made some money. Okay, so it's not a problem again. Now let me give you another scenario, the last scenario as an investor. So you bought XYZ share for $2. Okay, the price went up to 210 a month later. Again, no problem. You bought at the right price. The price seems to be going up. Okay. And 2 months later, the price fell to 180. So you face this situation again. Should I hold or should I sell? All right. But because I'm long-term investment, I keep on holding. But 3 months later, the price fell to 160. Okay. So now it's gone up 40 cents. All right. Which is about 20% down now. All right. And you'll be getting now you're facing this hurdle again. What do I do? Right? Should I sell or should I hold? Okay, fundamentally the company is still doing quite okay. The prices are still, the business is still doing well. Okay, look at the reports; they are still having good revenues and good profits. Okay, and then we just wait, right? So at this juncture, we want to decide: should I sell or should I hold? Okay, because it's already gone up 20%. Now 4 months later, the price gone down somewhere to 140, and you know what? The price has gone down too much. I bought it at $2, and now it's gone down to 140. It's really down 60 cents. Okay, and now I'm seriously thinking, should I sell? So you know what? Because I do not want to incur more costs. This is not what I'm expecting. I bought at $2, it's now at 140, I better go and sell. All right. So after you sell at 140 and 6 months later, the price went up back to $2. Okay, now this is where you felt like you have jumped off the cliff. Okay. And then 12 months later, it went up to $3. Now remember, your long-term objective was long-term investing, right? But sometimes, because of the short-term volatility, it may scare us off. We may have exited early, and the price starts to go up again over the long run. Okay, so how many of you would have gone through this situation? Okay, you don't need to say yes or no. You can just keep it in your head, keep it to yourself. But I'm sure we have gone through these experiences, right? Where we buy a special. Later, I'll give you a more detailed picture of where the price is and when we make trading decisions. Okay, so we like what? Let me see. I've actually got a comment here from who said it was a roller coaster ride earlier, right? Okay, I think some of you mentioned roller coaster, but okay, now I can't find that question. So the short-term volatility has actually, kicked out some of the long-term investors who don't really, understand the stock behavior that they're investing in, and they will go through this kind of situation. Okay, so one of the things that we want to learn from this is called a maximum drawdown. All right, because we do not know when we start to buy a share, whether the price is at its peak or whether it's at its bottom or whether it's somewhere in the middle. We do not know, right? But of course, if you know what you're doing, then you'll find prices when they're falling lah. Okay, but it's not that easy also. But again, we do not know. When price fall, it can fall even lower. Okay, we just do not know where the market is moving. Okay, so we need to know the characteristic of a stock. A drawdown means what does a drawdown means, right? So a drawdown is basically a fall of price from the peak to the bottom in a specific period of investment, or it can be a stock or a trading account or a fund. All right. So we all know that price don't go up all the way. It will go up and then it will form a peak. It will pull back again, and that's a drawdown. Okay. If you buy the stock, all right, and it goes up, it's going up. But once it starts to pull back and once it starts to come down, that's a drawdown. Okay. So in this case over here, in terms of your portfolio, right, we have times when the price goes down. Like for example, in this particular chart over here, you see on the red lines. That's where the prices start to come down, right? And you see that the biggest decline was, let's say, between $1 to 60 cents. So this price in this period, in this historical period, the biggest fall it ever made was 40 cents. Okay, which is 40%. That's the biggest fall. That's the maximum or the biggest drawdown. If let's say you bought this share at $1, your biggest drawdown will be 40% for this particular counter. All right. The others are all smaller. There are also small drawdowns, but the biggest one is where we have to take note of, because if this can happen historically, and if it happens frequently, then in the future it can happen. Okay, so what we want to take note is this big or the biggest decline from peak to bottom. Okay, just in case if you have bought this share at the high, in this case like $1 over here. All right. Now, let's say you buy the share at 80 cents. Okay, at 80 cents. Okay, the price went up to $1, you make money, but the moment it goes down below 80 cents, you have a drawdown on your account, right? That means you go negative. So, for example, if you buy the share at 80 cents, the price went to the lowest at 60 cents, your maximum drawdown in your account will be 25%, because 80 cents, from 80 cents to 20 cents is a 20 cents difference or 20 cents loss. Okay, so 20 cents of an 80 cent share is a 25% decline. Okay, that if you buy at 80 cents, all right. If you bought the share at $1, then your maximum drawdown will be 40%, right, or 40 cents. Everyone okay so far? Okay, if you guys are okay, if you have questions, you can ask those questions. If not, I'm going to go on. If you have questions, then you can type in. Yeah, I know there's this slight few seconds delay. Construction at bottom. Now, of course, if you bought at the bottom at 60 cents, in this case, you will not have a drawdown now. Okay, anything below 60 cents, you are in the money all the time. Okay, but this is just a period of time, right? It depends on where you buy. Okay, you can continue to ask those questions as I go on. All right. Okay, so understanding drawdowns prepares you for volatility ride. Remember, one of you guys mentioned that it's a roller coaster ride. Okay, so let's say you do an analysis on this particular stock over a period, or maybe you don't need to go and look for like 20, 30 years, maybe over the past 5 years or 10 years is good enough. And you see in that 10-year period, what was the biggest fall in prices? All right. So like in this case here, for example, you see the price usually fall about 5%, 5%, 5%, but there is one period of time where it fell 15%. Okay, so that means there is a chance that you can get a maximum drawdown of 15% if you buy at the peak. All right, if you buy at the peak. Yeah. So you buy the peak and the price comes down to 15%, and it did happen before, and it may happen again in the future as well. Right, especially if the stock is volatile. Okay. So if you understand that this is a drawdown of 15% in the future, if the price do come down 15%, you are ready for it. All right, you are ready for it. And if you know that the maximum drawdown is huge, the volatility is huge, when you buy this particular share, you may not want to buy a lot. All right, because it has this volatility. And I'll give you an example later on the calculation on how you can adjust your portfolio if you want to use this as a guide. Okay. Now, let's say okay, this is a very simple portfolio. Let's say you're managing. Okay, now let's say you have 100,000 ringgit. Okay, let's say you have 100,000 ringgit. And you bought 4 shares. You have 4 shares in your portfolio. That 4 particular shares, their maximum drawdowns, if you bought at the peak, will be different. Okay, for example, stock A has a 10% maximum drawdown historically. Stock B has a 10% fall. All right, the biggest fall was 10%. Stock C, the biggest fall was 30%. Stock D, the biggest fall was 20%. Okay, now let's say I do not use this as a guide and I just buy them equal weight. All right, so I have $100,000, I have $25,000 each of this share. Okay, so the weightage is 25% each. Now, let's see what happens, right, if the price change. Okay, if the price goes up, let's say 10%. Okay, let's say in the maximum drawdown, all right, okay, the price do go up 10% or go down. It can be up or down 10%. So you go down 10%, this one go down 10%, this one goes down 30%, this one goes down 20%. All the stocks went to the maximum drawdown. All right. So if stock A, 10% of 25,000 will be 2,005. So same with stock B, which has the same weightage, also gone down 10%, let's say, also lost 2,005. Stock C, because it's more volatile, it has gone down 25%. It's gone down 30%. All right, so 30% will be 7,005, and stock D gone down 20%, which gives you a loss of 5,000. All right, so you basically lose 17,500. Okay. The effect on the portfolio, which is the last column here. So stock A, because the price went down 10%, you lose 2,005, which is actually 2.5% of your 100,000. So you lose 2.5% of your portfolio for stock A, although the stock price has gone down 10%. Okay. Stock B also gone down about 2.5%. Stock C, all right, because the drawdown is huge, that takes up 7.5% of your portfolio. Okay. And stocks D, because it has gone down 20%, it has taken 5%. So that takes about 17.5% in your portfolio. Okay. Now imagine if you bought more stock C, all right, you put more weightage on stock C, it will have a significant impact on your portfolio. Okay. Okay, let me just answer your question. Nicholas, Benny, long time no see here. I thought I saw Johnny Depp. Yeah, it's been 1 year. Pushpa, how to know which is the low price? This is where it comes to the trading plan, right? You use different tools to try to identify where the price at the bottom and so on and so forth. But here I'm not going to discuss about that, right? I'm going to discuss about what do you do with stocks that are volatile so that you get prepared for it. Desmond, can you list up any causes that affect the stock price? It can be a lot of reasons, right? It could be when the prices are already too high. It could be when the market is not doing well. It can be, a lot of things can affect the stock market, like interest rates, commodities prices, the recent COVID-19 pandemic that we see. All this can actually affect stock prices. Okay. Main reason. Main reason, okay, prices are determined by market, right? Okay, market sometimes can over speculate. Prices in the market always try to find the value of a particular stock. Okay, the value is really difficult to identify because it keeps on changing, right? Companies make profits. It can make losses over time. It can make profits again. And the value of the company changes all the time, depending on whether there are any changes on the companies itself. All right, so the market always trying to find a value, but it cannot really find the true value. So sometimes, for example, the value of the company may be $1, but the stock price may be trading at $3. Why? Because the market is also quite forward-looking. Okay, they probably think that this company is worth trading at higher prices because it has a good prospect to grow. Okay, that's why we have the PE ratio, right? Price over earnings ratio. If you buy a company that is 10 times PE, meaning that their share price is trading 10 times above its earnings. Okay, tech companies can go like 60 or 100 times PE. Okay, and another reason could be sentiment as well. If there are, if there is bad news, market will just sell because they know that this company or this business will probably not be able to go through this, and then they start selling. Okay, there could be adjustments of portfolios by institutions and so on and so forth. So there are many reasons, right, that can affect stock prices, whether they are fundamentally good or not. All right, so don't think that a good fundamental stocks, the price will go up straight all the way. All right, there are times when the price starts to come down again, and there can be many different reasons. So what we do is on the chart, we look at the price historically, right? And we're going to find what was the biggest decline a stock can actually move, right? So that at least you prepare for it. Whether it's going to happen in the future or not, at least we prepare, because if it can happen in the past for this particular stock, it can happen again in the future. All right, so that's what we're going to take note of. Now, let's say, okay, we're going to do a weightage based on the maximum drawdown. That means if the stock is more volatile, I will want to trade lesser, okay, or have a smaller percentage in my portfolio, so that if the price do go down aggressively, it will not affect my portfolio too much. All right. Now, this is basically just a very basic idea. Of course, it can get more complicated than that. All right, depending on your portfolio, depending on the stock that you're looking at, and so on and so forth. But this is just by looking at a very simple example, and I want to show you the effect, okay, of managing this based on the maximum drawdown. All right. Now, what does this mean? So, if let's say there's the same drawdown, right? Stock A has 10% maximum drawdown, a maximum decline it ever had let's say over the past 10 years is 10%, stock B also 10%, stock C 30%, stock D 20%. All right. So what I'm going to do is I'm going to create an X factor here, right? I want to make all the stocks equal weightage. So here I use the biggest one as the anchor point. All right. So 30 is the highest, right? So in order for 10 to become 30, I have to multiply by 3. In order for that 10 to become 30, I have to multiply by 3. So 30, I don't need to multiply because that's the maximum already. 20, I have to multiply by 1.5, so I get 30. So now I get an equal weightage all to 30. So I have this weightage right now, right? So the X factor is actually the weightage 3, 3, 1, 1.5. So from my $100,000 investment, all right, and with the weightage of 3, okay, I'm able to buy 35,294 worth because I'm dividing them into 4. All right. So 3 over 8.5 times 100,000. If you know how to do the weightage calculation, all right. So the weightage here is 3. The total is 8.5. So 3 out of 8.5 multiply by 100,000, you get 35,294. All right. So stock B is the same weightage as well as A. Stock C, 1 out of 8.5 times 100,000, so it's 11,765. And stock D, I get 17,647. Okay, so now the weightage is different. So the percentage in my portfolio right now, if you look at this, stock A has 35% of weightage in my portfolio. Okay, stock B, I have also 35.3 because stock A and stock B has the same maximum drawdown. But stock C, I only have 11.8%, which is actually 3 times smaller than B. All right, 11.8% of the weightage in my portfolio because I'm only investing 11,765. Okay, stock D will be 17.6%. Okay, now the effect will be this, right? So the price change, the same thing happened. Okay, the stock A go down 10%, stock B also down 10%, stock C down 30%, stock C down 30%, stock D down 20%. So all of them is down as well. Okay, but because now I have equal weightage in terms of its drawdown, in terms of its volatility, my profit and loss will be the same across all counters. All right. So although stock C fall down 30%, okay, stock C has gone down 30%, but because I only trade lesser, then the losses that I made in absolute value will be smaller as well. All right. So all of these 4 stocks, I lose about 3,529 each. Okay, which takes up 3.5% of my portfolio. Now, so if I look at this, the difference is, the first one, if I do not do any weightage at all and treat all of them equally, same weightage for all counters, I would have lost, let's say the price all come down, right? According to the price change I just said earlier. Okay, I have lost 17.5% in my portfolio. Okay, but if I do this weightage, then I will have only lost 14.1%. Okay. So again, this is an idea. It can get more complicated than this. All right. But this is just to basically tell you that if the price is more volatile, then you should not be investing more. You should be investing lesser. All right. So that it will not have an effect significantly in your portfolio if the prices start to come down. All right. Okay. Is there a technical problem? Let me check and see whether it's still going on or not. Okay, Wong Teck Fui says high risk, high return. Yep. So if you can stomach the volatility, then yeah, I mean, go for it, right? If you, for example, if you know that the stock has a drawdown of 30%, okay, then at least you know that when the price comes down 20%, it should not scare you off, isn't it? Okay, because it already tell you historically that he has gone down 30% before. Okay, it should only scare you off if it has gone down 50% lah, because that was not expected, right? Okay. Can't see my charts, Pushpa. There's no charts. There's only a table there. There's no charts, right? But anyway, these are all in the slides. All right, you can download it later. I'll give you a link where you can download. And you know what? This video will also be up there. You can view again if you missed my point earlier or you have came in a little bit later. All right, this video will be recorded and it will be shown again. Okay, so basically, the reason why we want to understand the maximum drawdown is so at least you understand that, in the future, if the stock do go down, all right, that much, this is expected. Okay, if you can accept it, then it depends on you how much you want to invest in a particular counter. All right. Now I'm just going to show you an example on the charts right now. Okay, now one of the so-called, I don't know, like this in my opinion is a good fundamental company, right? Dialogue, for example. Okay, so you look at this particular chart, the price has gone up quite significantly. Of course, over the past 1 year, a lot of counters has gone up quite significantly, right? But if you bought at the peak, for example, so you look at this particular counter over here, right? Sometime in September, this is I think in 2018, 2018, right? This is a weekly chart. So one bar there represents 1 week of movement. All right. So the price, if you look at this particular stock, so Dialog, let's say if you bought the price at the peak, at the highest level here. Let me see. So let's say you buy at the highest level over here. Okay. Let's say you don't know. There are people who bought at this price, isn't it? If not, the price would not have gone there. Okay. And the price actually went down 25% to its bottom. So that means if you bought at that high, the price actually did fell down 25%. Okay. Now, of course, there are also some drawdowns, all the smaller drawdowns here, right? They are also declined here. But I want to look at the bigger ones, the maximum ones, the bigger drawdowns. Like here, it went down 25%. After that, the price rebounded and it went up again. Okay. And then what happened after it reached to this peak? The price actually came down again. Okay, this time 24%, almost 25%. So if you look at this particular counter, it can fall 25% despite being a fundamentally strong company. Like I said, the price don't go up all the time, right? You're bound to have some adjustments or some correction. Okay, so we have to get note and get ready for the adjustments. Okay, that if you buy at a high lah. Okay, even if let's say you buy somewhere in the middle here. Okay, you have if you bought here, if the price come down here, it still goes down at least 12.5% or 13%. Okay. Now, why do you think people buy at this highest level? Because if it's a fundamentally good stock, okay, people will buy normally, and they normally don't look at prices. Okay, long-term investors, because they are looking at it at a longer term point of view. They bought at this price, knowing quite well in their own understanding that the price can go even higher from even this high over here. All right, and it's going to be long-term. Okay, but in order to achieve that long-term returns, you have to get ready for this volatility. Okay, so like in this case, for example, Dialog has gone up 25% historically and down 25% as well. One time in 2018 and one time in 2019. Okay, so if I'm going to look closer today, right now, this is the current stock price from the so if you look at this chart, this was the chart that I looked at earlier. Right? After going down 24%, it went back up again and create a new high. Okay, so what happens if let's say you buy at the new high, and right now you look at the price that's actually pulled back 25%. Okay, and this happened in this is somewhere in May last year. Okay, and today it is now down 25% from the high in May. So if I already expected that the price will fall 25% historically, the fall right now 25% does not give me any jittery because this was expected. Okay, now it also doesn't mean that you can actually buy down here, and when the price fall down 25%, that means you can start buying right now. We just basically tell you that, if the price do fall 25%, and if you have bought at the high, at the historical high over here, this is expected. Okay, so whether you want to buy this particular counter right now is really up to you because the price has already fallen 25%, but that is in a bullish market, right? What happens if, let's say, the market is in a bearish market, it can fall even further. Okay, but at least you know that the price has already fallen 25% for this particular counter. Yeah. Okay, so let me answer some of your questions before I go on now. Colin is asking, how do you justify it to be used on turnaround growth? So that's why I said, Colin, it can be a little bit more complicated, right? Depending on your risk profile. Okay, you categorize your stocks into different kind of categories, right? Investment grade, growth. If you are more risk taker, you want to look at turnaround stocks. If you are not a risk taker, you may want to look at all investment grade stocks, right? Like maybe like Nestle lah, like stock that move that not much, they pay good dividends and so on and so forth, right? Like public bank, maybe not public bank for dividends, maybe Maybank, all this kind of things. So you need to balance that portfolio at first, all right? And then from there, you deep dive again into that volatility, and you see how much should you be investing in a particular counter. Okay, so I'm just basically showing you the spreadsheet earlier. It was just an idea. All right. Okay, Sam, will Dialog go back to RM4? That's the question, right? Okay, so today we are not into a technical analysis or market forecast, but let me tell you this, it will go back to RM4, but when, I do not know. Okay, it eventually will go there, because as long as the stock is fundamentally good, then in the long run, it should get higher and higher. Okay. Okay, how do you respond if your strong long-term stock experiencing huge correction? Now, in a trading plan, there are also, even if long-term investing, you don't keep on holding your stock, right, forever, right? So there is a reason why actually price moves down very aggressively. Okay, maybe the fundamentals has changed. Maybe the earnings are not as good as before. Okay, and then you have to adjust your portfolio. Definitely, you're not going to hold and buy and hold forever. Now, for example, if you are planning to buy this stock for 5 years, right, and you continue to monitor the fundamentals of the company, so quarter by quarter is still making good profits. There's still earnings growth. They still have good cash flow and so on and so forth, and it's still growing and growing and growing. So that's fine. I'll keep on holding, right? But if I see a flag on the business, all right, and the fundamentals are not growing as I'm expecting, then I may start revising it, right? I may start even selling it. Okay, or when the price goes up way above its value, I may want to sell as well. Okay, so in this scenario, for example, if the fundamentals of the company has not changed, all right, and the business prospect of that particular sector is still good, even if the price falls down 25%, and if I do buy at the peak, right, I will still be holding this. Okay, I'll probably buy some more if the price go down 25%, because the fundamentals has not changed. It's just that market gets jittery sometimes and the prices are overbought. Right? Remember, I told you markets can sometimes be over speculated. Okay, and if you are into investing or value investing, okay, you will not be buying at the high in the first place, lah. All right, I'm just giving you a very worst case scenario if you bought the share at the high. Okay, value investing is supposed to buy when prices are actually falling, not when it's going up. Okay, now trading is the same thing. For me, my trading philosophy is always not to catch prices when it's going up. I always wait for the pullback. All right, so for example, now Dialog has pullback. Is it time to enter? Then I will use my trading plan. Has the price fall into my trading plan? All right, has the price fall into the criteria that I set to buy before I buy this particular stock? So that's where your trading plan comes in. Okay, but what I'm showing you is the worst case scenario. If I'm caught off guard, right, and bought at the high, okay, and the price came down, yeah, I should not be worried about this, because this is normal. Okay. Louis is asking, does long-term investment also utilize the market structure trade? Dialog made a first swing in a particular spot is broken. Do I sell? Well, yeah, I mean, in a long-term strategy, you can do it. You can do it as well. All right. You can use a little bit of timing in your investment strategy, even if it's long-term, right? But your strategy would be completely different. Okay. Mine will be a little bit different when it comes to investing. Okay, if that fundamentals, also when you do long-term investments, okay, the major analysis that you have to make is not on the market prices, because market is very noisy, it fluctuates, right? The major decision has to come from the fundamentals of the company, and of course the business prospect and the sector that is serving as well. Okay, if the sector is doing well, and if the company is doing also very well, then there is no point for me selling this share. All right, But if I'm going to use technical analysis, even if I identify, like Louis said, right, if let's say the price has gone up so high and you see a reversal pattern is happening, now even if I see that pattern as the price is probably going to fall, if I'm going to sell, I will not sell everything. All right, I'll probably sell just 50%, hoping that the price comes down, and that from the 50% that I sell, I can buy more shares later if the price comes down. All right, because as long as the stock fundamentals don't change, the sector don't change, the business prospect don't change, there's no point for me selling. Okay, I use technical analysis or timing a little bit to just let me get out prices a little bit higher, so that when it comes down, I can buy back again. I can buy back more shares because it's cheaper right now. Okay. So one of the things, right now, if you are trading or investing, one of the things that you do, because I do both investing and trading. Okay, I separate the portfolios differently. Okay, an investing portfolio and a trading portfolio. All right. So investing portfolio is for long term. Okay, and like I mentioned to you, the long term portfolio, even if I sell, okay, I will not sell. I will completely, probably sell half or even 30%, depending on the market, and I'll buy back again eventually. All right, because it's for long term. Okay, but for short term, my short term portfolio will be different. Sometimes I can buy the share, today, and then I can sell everything again 2-3 days later. Okay, so don't combine both your short term portfolio and your long term portfolio. Separate them. That's the best you can do. Okay, then you don't get you don't get confused by your investment strategy. Okay, if you decided to go long term and both long term and short term lah. Okay. Now the stock is in a downtrend. Can it drop another 25% from the latest downtrend high? Yes, possibly it can continue to drop, right? Like I said, that's why you can't use this as an indicator to buy. Okay, although historically the price can go down 25% the maximum, it can go lower. Okay, provided that, of course, like you mentioned earlier, right? The stock is in a downtrend. That means the whole sector is in a downtrend. Then we have a bearish trend. Okay, in the bearish trend, the stock can go down like 50%, 60%, or even 80%. Okay, the fundamentals have changed. If the market is in the downtrend, isn't it? There's a reason why markets go into a downtrend. Okay, so if the fundamentals have changed, then of course I have to make a investment decision. Should I cut the share and wait? Okay, because there are other opportunities. For example, if I'm going to sell Dialog, let's say okay, just an example, if I'm going to sell this particular share which has fallen 25% and it's going into a downtrend, let's say the oil and gas industry is not going anywhere, which is not the current case, right? Because oil and gas, oil prices are going up. Okay, but the stock price has been coming down. Okay, so there is this divergence here, right? So as long as the fundamentals have not changed, then I will still hold. Okay, but if the fundamentals have changed, if the oil and gas industry is coming into a downtrend, then I will sell this. I'll sell this counter, and I will look for another counter which maybe belong into a sector that is growing. Okay, of course, find a good fundamental stock, because this is an investment portfolio. All right. So depending on your strategy, right? It really depends on your strategy. So first thing you do is don't mix your short-term and long-term investment portfolio. Okay, separate them. It makes things much easier. Okay, so let me go on here. So that one, if you think it's volatile, now this is even more volatile, right? This is Inari. So Inari is also like another darling stock in the semicon industry. So if you look at this particular counter, right? This counter, the biggest fall was, of course, in this is in 2019. Okay, sometime in December all the way to April, for about 4 months, the price has fallen 56%. Now before this, it has also fallen 52%. Okay, and then before this was 37%, 35%. The decline was smaller, but the biggest drawdown, the biggest decline was about 52 to 56%. All right. So meaning if let's say the current price is over here, and if I'm going to buy the stock at this price, okay, and this is the current historical high, right? So the moment you buy a stock where the price is at a historical high, then prepare for a drawdown. All right, because the higher the price go, the higher the lower the price can fall as well. Okay, Now in this case, for example, if I'm going to buy at this high here, if the price do fall, if it falls 10%, it's normal. If it falls 20%, it's normal. If it falls 30%, it is normal, right? If it falls 50%, also normal, because it did fell 50, 52, and the biggest here was 56%. It did fell 56% before. But you know what? Eventually, the stock recover, isn't it? Okay, although we have seen the big decline over here, but over the long run, and you look at most of the fundamentally good stocks, over the long run, okay, the price generally goes higher. So every 5 years, 5 years, and 5 years, for example, you see that, if you calculate from today, next 5 years, you'll see that the price will go higher. From that 5 years onwards, you go higher. As long as the company fundamentals has not changed, it is still strong, it is still as good as it used to be, or maybe even better. All right, the price will eventually go up. But if you compare this particular stock, right, like Inari and Dialog, what you see here is for Inari, you see there's more volatility, right? As compared to Dialog, although it's 25% fall, which is quite big, but as compared to this is like double, right? It's 52%, 56%. Okay, it's more volatile. So that's what we do not see, isn't it? It's always easy to say, you know what, I should have bought this stock 10 years ago and hold it today, I could have made good money. But in that 10-year period, you have gone through this roller coaster ride. And sometimes if you are not prepared for this roller coaster, what's going to happen? You get thrown off the roller coaster. All right. After buying this particular share, after a year later, the price come down 10, 20%, you got scared, you get out, and then the price go back higher and higher and higher. So you get thrown off of that bullish trend. Why? Because you are not ready for the volatility. Okay. So this is what I meant. So you have to look at the volatility of every counter that you're investing. So at least you prepare for this. Okay. Again, this is not a tool for you to use to determine when to get in and when to get out. Okay, that is for your trading plan. Okay, this is basically once you already have a trading plan and you try to execute the plan, and sometimes we get thrown off the roller coaster is because we are not prepared for it. Okay, we are not prepared for these big drawdowns. Okay, so once we understand this, then at least we know that if I'm going to buy now, for example, this counter, if it falls 30-40%, it's normal. Okay, because I'm going to buy, even if I buy today, for example, this counter, I'm going to hold it for 5 years, isn't it? Or 10 years. Because remember, this is for long-term investment. I'm not talking about trading over here. I'm talking about long-term investment. Okay. So any questions? So if you guys got it, all right, can you just put a thumbs up or just say yes? Okay, so that I know that you are following. Okay, so the idea here, right? The idea is basically very simple. You just have to look at the shop. If you have time later, I'll just show you, and you can use a chart and just look at where are the biggest falls, and you just prepare for it, right? Any questions before we go on? Thank you, Patrick. Okay, so remember, right, when you buy a stock, especially long term, because you are investing in long term, right? Your objective is long term. Okay? You have found a fundamentally a good stock, but the question is, are you ready to go through the volatility? Okay, so every stock that you buy have different characteristics. Some are more volatile than the other. You cannot treat every fundamentally good stock as equal. They behave differently. Okay, so that's my main message. All right, and then you adjust your portfolio. The spreadsheet that I share with you is basically just an example, but of course it is used. You can modify your portfolio better that way as well. Okay, so thank you so much. Thanks, Boon Keng, Anis, Tong, Ong, Kin Boon. Okay, I hope the rest of you got it. But if you came late, don't worry. You can always view back the video later. Nai or why Nai? Long name. What is the best way average down method? Okay, again, that comes to the trading plan or investment strategy itself, right? There are many different ways to do it. I cannot cover everything here. Like I said, having a strategy or investment or trading plan, that means knowing when to buy and when to sell, that itself gives you an edge, right? So you notice my title here today is about having an extra edge. So two people can have or implement the same strategy. Okay, two-person have learned the same thing. They invest in, they have the same methodology, and you know what? Both of them invest in the same stock. Okay, but after 5 years, both of them, the results can be different, right? Learn the same stuff, learn the same strategy, the same trading plan. You learn the same fundamentals analysis, same technical analysis. But the results can be different for these two traders or two investors. Why? Because one of them is prepared. Okay, by understanding this itself, he knows that he will go through this volatility and he understands it, right? So this guy has an extra edge. Okay, so that's what the extra edge is all about. Okay, so if you do not have a strategy or trading plan, go and learn. All right, and of course you can learn from Equity Tracker. We do provide, we do provide value investing courses, and we also do have trading courses. Right, so do check us out. Check us out at equitytracker.com. Right, so that's basically strategy. So this is additional. All right, but of course there are a lot of other things that you can actually get an edge in the market. Okay, so hopefully I'll share it maybe in the future webinars. How can we view back the video? Once this has ended, you can always go back to where you looked at. Automatically, the video will be shown there. All right. Okay, now I have to go on. On notice it's already 9, so we're probably going to take a little bit, maybe another 15 minutes more. Okay, and then we'll take a look at examples. Now let's take off the investor's mindset. Now let's go into trading. Okay, so trading is basically short term, right? One of the biggest fear for traders is getting stopped out too early in a trade. Getting stopped out too early. Maybe sometimes in trading you always have your target prices when you buy, your target prices, and you also have this thing called a stop loss, right? In case if you buy and the price don't go up and it starts to come down and it goes down to a certain level, says it's not going up, I'm going to accept. It's not going up, I'm going to cut my losses. All right, so trading normally have cut losses. Okay, but for investment it's different, right? For investment we don't really have cut loss unless there's a fundamental change, okay, in the company. Okay, but trading is more short term in nature. So one of the biggest fear is what? Getting stopped out too early. That means you cut losses, and the moment you cut losses, the price go up again. And that can happen even if you have a trading plan. All right, even if you have a trading strategy or whatever, this still happen. The moment you buy, the price came down and you cut your losses, and then the price goes up again. All right, now this example. So you bought this share XXX for $1 and you set a stop loss at 90 cents. That means if the price comes down 90 cents, you know what? It's not going up anymore. It's not where I'm expecting to go. I'm just going to cut my losses short. All right. So this is let's say my trading plan. So 3 days later, the price fell to 95 cents. Okay, not a problem because I set my stop loss at 90 cents. So it hasn't gone down to 90 cents. So I will not sell. All right. And then 9 days later, the price went up back to $1. So it comes back to break even. So I'm okay, not so bad. Okay, I'm still following the plan. 15 days later, the price went up to 120. So I already make 20%. Fantastic, right? 20% after 15 days for short-term trading. Not bad, isn't it? Okay, so first scenario is not a problem if the price goes up when you buy. And it goes down just a little bit before it goes up. Okay, not a problem, as long as it does not hit your stop loss. Now, second scenario, you buy the share, YYY share, for example, at $1, and you set a stop loss again at 90 cents. Okay? 3 days later, after you buy, the price falls 95 cents. You still haven't sold yet because it has not gone to your stop loss price. Okay? Then 9 days later, okay, the price has fallen to 90 cents because it has gone down to your stop loss price, and your trading plan says, you know what, you better sell. So you sell, right? Because you're following your trading plan. You sell. 15 days later, the price fell to 70 cents. Now you feel happier about it, right? Because you sold at 90 cents and now the price fell down to 70 cents. and then you'll be thanking to yourself, and you'll be happy because you have followed the plan to sell at 90 cents. Because if I did not sell at 90 cents, I would have hold the stock now and I have incurred much more losses if the price falls down to 70 cents. So it's fantastic. Okay, I'm glad that I followed the trading plan. Now, third scenario, bought ZZZ share at $1. Put a stop loss at 90 cents. Okay, price fell to 95 cents after 3 days when you buy. Okay, 9 days later, the price fell to 90 cents and you sell, you're out again because you're following the plan, right? Okay, now 15 days later, the price went up back to $1. And then you be thinking to yourself, I should have not sold that share at 90 cents, right? Because the price now came back to $1. And then 20 days later, you went back to 120. And this is where, at times, when you kick yourself and you tell yourself, you know what, I shouldn't have followed my trading plan. I should have just hold it, right? And then the price went to 120. So this is a scenario when we sometimes cut our losses too fast. Okay? And one of the reasons is because we do not set a correct stop loss price or stop loss mechanism. You may put your stop loss too close. All right, too close. Okay, so the question in trading, this is the most difficult part, right? Because every time, when we are trading, we always ask ourselves, where do we set the right stop loss? If you set the stop loss too big, for example, you buy at $1 and you put the stop loss at 80 cents, then there's a chance that you can lose 20% or 20 cents, right? Your risk will be bigger. If you put 95 cents stop loss, that means only 5% decline. Okay, if I put too short, then I may get stopped out too early. Okay, so the question is, where is the right one? What's the right stop loss to put in? Okay, so I'm just going to go through here very briefly. There are two different kinds of stop loss, right? There's a fixed stop loss. That means, some trader, they always put 10%. It's a fixed stop loss that they put. They always put 10% stop loss, 10% stop loss for every single trade that they're trading. Okay, that's what we call a fixed stop loss. Okay, and then there's another thing called a dynamic stop loss. The stop loss is determined by an indicator for every single trade that you do. Okay, you could use a trend line, for example, or in this case, you could use, let's say, if the price falls the lowest in the past 3 days, I'm going to sell. All right, so I'm using an indicator here to determine my stop loss. So every counter, when you trade, you use different indicators. Right? Or I could use, if the stochastic cross downwards, I'm gonna set my stop. Right? It can be many different indicators, but it's not fixed. Okay, not like a 10% stop loss all the time. Okay, setting the stop loss will determine your trading risk. Like I mentioned to you, if you put the risk too big, if you put the stop loss too close, then you can easily stop out. If you put your stop loss too big, then your risk will be bigger. Right? Like in this case, right? So let's take a look at this. If let's say your buy price is at this green line over here, okay, and let's say your stop loss, let's say the first stop loss if you put here, your risk will be the difference between your buy price and your stop loss price. All right, because if you buy at this price and the price do come down and hit your stop loss, this would be my risk. This is how much I'm going to lose. If I put the stop loss lower, for example, number 2, then my risk would have been bigger. Okay, so question is, which one do I put, right? How much? Which one with the right one? Should I put a smaller stop loss or a bigger stop loss? Okay. Now, the stop loss should be set depending again on the stock volatility. Okay, remember in investment we look at the maximum drawdown, right? The lowest decline from its peak historically. Okay. So stock in the short term can also be volatile. All right. Now, if the stock is volatile, then you have no choice but to put a bigger stop loss, because by nature it is volatile, right? If you put a very tight stop loss in a volatile stock that you are trading, I can guarantee you that you'll get stopped out most of the time. Okay, you get a scenario where you kick yourself most of the time, because the moment you hit the stop loss, you cut, the price go up back again. Okay, so the higher the volatility, the bigger the stop loss. You cannot try. If the volatility is smaller, then no problem. Okay, so let's say you put a let's say you buy over here, okay, and you put a stop loss down here, for example. Okay, so and another scenario is where you can put a stop loss also down here, a bigger stop loss. Okay, but don't worry, I'll give you the answer after this, what kind of stop loss that you should be putting, right? So let's take a look at two different scenarios. One, you put a stop loss which is smaller, and another stop loss which is a little bit lower. Okay, now let's see what happens. If let's say the price comes down, it goes up, it hasn't hit your stop loss. Okay, the first stop loss also hasn't been hit, so not a problem, right? But because this stock is volatile, suddenly the price came down and hit below a stop loss one again. Okay, stop loss one, because you already gone down to that price where you set your stop loss, you're already out. Okay, but if you put a stop loss number two, the price hasn't hit that stop loss number two, and if the price do rebound, you will be able to profit from this. Okay, simply say that if you put at stop loss one, you get stopped out a little bit too early. Right, and you put a stop loss two, the price did not go down to that level, and eventually when the price rebounds back again, then you will be profiting. All right. Now, the reason why traders put a stop loss is because you want to give the price enough room to develop its trend, right? Because the price don't go in a straight line method. If it goes up, means it doesn't go up like 101, 102, 103, 104, straight line method, right? If it go up to 102, 104, it can come down to 101, it can go to 102, 103. So you give it enough room to move. All right. So we do not want to give it too big of a room, because then your risk will be too big. All right. If you put a stop loss too low, give it a lot of room. The moment the price comes down to this low, you're out. You're going to incur a lot of losses. That's what we do not want as well. Okay. Michael, you seem to be going off and on air, but I don't receive any problem on my side. I'm also viewing this live, and I still don't get anyone having this problem. It's probably your internet connection, right? Bursa only allow traders to key in either target profit price or stop loss. That depends on the trading platform that you are using, lah. All right, different brokers have different trading platforms. So yes, you can set orders in different orders in different platforms, like stop orders and limit orders and so on. You have to make use of the orders. Okay. Now, how do we set the right stop loss, right? Now, one of the indicators that you can use to identify volatility in the short term is called the average through range. Okay, now, by definition, range. Okay, range is basically the difference between the high and the low of a specific period. For example, it's a day's range. That means the high and the low in that particular day, right? Or the hourly range. That means what's the range every hour of the trade. Or the weekly range, the highest in the week and the lowest in the week. That's the range. Okay, so range is normally used to calculate price volatility. Okay, so that's the normal way of calculating range. But here I'm using this another a little bit more. I will not say advanced, but this is a more unique way of identifying range. It's called the average through range. Okay, by Valles-Wilder, the same person who created the RSI indicator. Okay, now I here, if you already know the ATR, that's fine. Okay, its short form is called the ATR, right? The average true range indicator. So what's the difference is this. Okay, so here's the explanation, but if I can explain to you on the chart, it's much easier. Okay, now the range, remember, is the difference between the high and the low. So I'm taking this, for example, let's say this is a daily chart, right? A daily chart. So one candle here represents a day. So this is a daily chart, right? So the high is here and the low is here. So if I calculate the range, I take the high minus the low, I get the range. Now, why is it through range? Now, through range also takes account into the previous day's close. Okay, that means yesterday's close. if yesterday's close is within today's range, then the true range will be the high, the difference between the high and the low. That means there is no gap between yesterday's close and the high or the low of today's candle. All right. So this will be calculated as a true range. Now let's take a look at the second scenario. Now, if you look at this, today's range is this high minus the low, right? This high minus the low. That's supposed to be the range, okay? But because yesterday's close is higher than today's high, okay? Yesterday's close is higher than today's high. I will replace today's high with yesterday's close to calculate the range. And therefore, this becomes a true range. So it takes account into the gap between today's high and the previous day's close. Okay? So a gap can also be a measurement of volatility. If you only use today's price to calculate the range, you only use today's data. See, so here, true range is where I also consider yesterday's data to calculate the volatility. Now, same thing here. Okay, if you calculate the range of today, it will be the high minus the low, right? The high minus the low, that's the range. But because yesterday's close is lower than today's low, okay, then I will replace yesterday's close with the low of today to calculate the true range. Okay, so I'm just basically explaining you don't need to do this calculation manually, because on the charting tool, the indicator is already there. It already calculates for you. So I just want to basically explain to you what's the difference between a true range and a range. All right. So true range, by Wilder definition, is basically considering yesterday's closing price. Okay. So average true range is the average of the true ranges lah. Okay. So let's say the true range for day 1 is 10 cents. Day 2 is 12 cents. Day 3 is 14 cents. Day 4 is 12 cents. Day 5 is 14 cents. So the average true range for the 5 days is what? You take all of this data, add them up, 10 plus 12 plus 14 plus 12 plus 14. You divide by 5 days. So the average range or the average true range for the past 5 days, in this case, is 12.5 cents. Okay, so if the stock is $1, that means the average true range is 12.5%. In other words, the stock can easily move about 12.5% a day. All right. Okay, so this average lah. Okay, 12.5%. So for example, in this range here, the lowest was 10 cents, the highest was 14 cents. Right, in these 5 days, lowest is 10 cents, highest is 14 cents. The average is 12.5. Okay, so that means this stock can easily move, okay, between 10 to 14 cents a day, or averagely 12.5% a day. Okay. Now, the average rate implies that the price on average moves about 12.5% a day, okay, from the previous example. So if you put a stop loss that is less than 12.5% for this particular counter, and if the price do fall 12.5%, and because you put a stop loss maybe at 9% or 8%, you can get stopped out too easily, because you did not give enough room for the price to move. Okay, remember I told you about giving the price enough room to move, right? So 12.5% is that room, that range. Okay, so if I put a stop loss that is at 12.5%, I can easily get stopped out. Okay, so whenever you put a stop loss, no matter what tool you use, all right, or what indicator you use to determine your stop loss, okay, make sure that the stop loss is more than your ATR. In fact, your minimum stop loss should be 1.5 times the ATR. Why 1.5, right? Because remember, if you calculate the range, the earlier example that I show you, the lowest was 10 cents, the highest was 14 cents, right? So it can still go to 14 cents, but the average is 12.5 cents. But there is a time when the price actually fluctuates 14 cents a day or 14%. Okay, so I put in 1.5 times the ATR. So giving a little bit more room, okay, to also try to cover the maximum ranges. Okay, so if I take 12.5 cents multiplied by 1.5, I will get a 19 cents ATR or 19%. That means this stock is very volatile. One day itself, it can move 12.5%. And you normally find this kind of counters which stocks are below, let's say, 50 cents, right? Because if the stock is, let's say, 30 cents, if it comes down 3 cents, it's already 10%. All right. So the lower the price, the bigger the volatility normally in terms of percentage of movement. All right. So the average true range indicator is available in most charting software. So you don't need to calculate this. You just have to apply it and just multiply by 1.5. Then you get your minimum stop loss. Okay. Now, for example, let's say you look at this particular counter. Okay, whatever trading strategy, but here I'm looking at a breakout after a sideways movement. The price start to break out, and now it's currently trading at 144. Okay, let's say I'm using a breakout strategy, right? The price is breaking out of a sideways movement, and I'm expecting the price to go higher. Okay, now immediately I can apply the ATR indicator. So here I'm applying a 5 days ATR. I just need to look at the volatility in the past 5 days and what's the average. By default, the ATR will have put in 14 days ATR because Wellers like to use 14 days. But don't need to use 14 days average range. It's too big of a data. I want to look at the current volatility, right? So either 5 ATR or 3 ATR is good enough. Okay, so here, the average range for the past 5 days for this counter, okay, you just apply this indicator ATR and look at the current figure. So here it says 5.5 cents. That means the average range for this counter is 5.5 cents. Okay. So my minimum stop loss, okay, so I take 1.5 multiply the ATR, which is 0.055 or 5.5 cents. My minimum stop loss should be 8 cents. Okay, so if my strategy say the stop loss is at 10 cents, no problem. Because it meets the minimum 8 cents criteria. Okay, so this ATR is not used as a stop loss. Normally, I will not use it, but I will use it to determine whether the stop loss that I put in my trading plan is enough or not. All right. So if my stop loss is 10 cents, okay, 144, I put a stop loss at 134, for example. All right. I put a stop loss at 134, which is a 10-cent stop loss. And 10 cents is bigger than 8 cents. So no problem putting a 10-cent stop loss. All right. So this is just the extra calculation, right? If you put a minimum stop loss at 8 cents, that means your stop loss price has to be 136. Okay. If you put anything below 136, you are fine. If you put at 135, 134, 133, it's quite okay. But if you put above 136, then you have a risk of getting stopped out too early. All right. Okay, this is another example. Okay, so this price has went down. Same counter, but you see different days, different times, different setups. Like this is a candlestick setup, for example. The ATR at this point is not 5.5 cents. This time is 7 cents. All right, so you take 1.5, multiply by 7 cents. Your minimum stop loss should be 11 cents. So if I'm going to buy at 128, okay, 11 cents from 128 will be 117. So if I put a stop loss below 117, it's fine. Okay, but if I put anything above 117, then again, I will have a risk of getting stopped out too early. All right. Any questions? So this is for trading. You don't use this for investing, right? This is trading. This is to basically decide whether the stop loss that you put in is enough or not. Yeah, and again, if you use this indicator, then again, it will give you a slight edge against other traders, right? Who have a trading plan, but they are caught with the volatility of the counter. Okay, so the one way of to calculate the volatility for this counter is by applying this average true range indicator. All right. Yeah, 1.5 is good enough because you give it a 50% extra range. Okay, don't need to go too far. You put 2 times, 3 times, it'll be too big, and then your stop loss will be too big already, right? 1.5 is basically just to cover that range, because we are calculating the average, right? And the average, sometimes, let's say the average is $1, but sometimes it can be 120, 130, or even lower 90 cents in that 5 days. All right, so we're going to just cover that. So 1.5 is good enough. All right. Any more questions? Nope, it is not used for target price. Again, target price all boils down to your strategy. Okay. Again, the ATR is also not used as a stop loss. It's just used to measure. Remember, it is used to measure whether the stop loss you put is enough or not. Okay. Yeah, peak and bottom. I mean, this can be used whenever you make a trading decision. Whenever you buy, okay, and you put a stop loss, you just have to determine whether the stop loss that you put is big enough or not. Whether it's 1.5 times more than the ATR. 1.5 times ATR. Okay, whether your stop loss is more than 1.5 times the ATR. That's the idea. Okay. So again, this is not a trading plan, or this is not even a trading. This is just an additional tool, right? This is not used to identify target prices. This is not used as a stop loss, but this is just to determine an extra tool to determine whether the stop loss that you put in is enough or not. Right? Like in this case, right? If your stop loss is 9 cents, okay, but the 1.5 times ATR here is 11 cents, but your stop loss in your strategy is 9 cents. 9 cents is definitely not enough. Okay, you have to find another stop loss. You have to find a stop loss that is more than 11 cents. Do you have any recommendations on how to put, depending again on your trading plan, right? Different indicators are used to identify different target prices. You can use resistance levels. There are many tools you can use. Again, we are not here to discuss a trading plan. And again, if you guys don't have a trading plan, go and learn from books, or you can always join our classes, right? Because we do have trading classes. We also have value investing classes. That's the most fundamental thing that you need to have before you even trade or invest in the markets, right? Because when I started my presentation, having a trading plan or a strategy is where it keeps your sanity in investing or trading. Can using the ATR for stop loss result in your trading being conflict with money management principle of not risking more than a certain percent? No, it does not. All right, because you first have to determine what's your stop loss. Okay, and then from that percentage stop loss, you determine how much you should position your size. All right, this is basically to just tell you whether the stop loss that you put in, is it enough or not. Okay, once you get, if it's not enough, then you have to put higher than 1.5 times the ATR lah, and then only you decide what position size. The position size is the one that's going to determine your risk or the percentage on your trading capital. Okay, any more questions? Okay, anybody want to look at any example? Just shout out a counter name. I'll just look at an example, and then I'll take a look at the maximum drawdown and also how to read the ATR simply. All right. I'm not going to determine whether the company is fundamentally good or not, because we won't have time for that. But just pull out any counter. The first one that comes out in the screen, I will share. Okay. Syntax. Okay, maybe just one or two counters. Okay, so I'm going to look at Syntax and Tech Bond. Okay, thank you guys for those who put in. So I'm going to take a look at Syntax, Tech Bond, right? Okay, let me stop the screen. Let me share another screen. Okay, so like I said, these tools are available in most charting software, and here I'm on Affin Huang E-Invest platform. They also have a charting tool over here, right? So I'm just gonna put in what was the counter name again? Syntax. Okay. Oops. Wait, I guess I have to go and sign it again. Okay, I'm just gonna put a chart for Syntax. Okay. So you can change this chart. I'm going to change this to, let's say, a monthly chart and try to load as many data as possible. Okay, so you look at this counter. So it's a monthly chart, and you can see how much the price has fallen. So you have all these smaller drawdowns, right? Let me see. Wow. Now, I do not know whether this company is fundamentally good or not. All right, but let's take a look at how much drawdown. So I can have this measurement tool over here. Let me see. Okay, that measures from this peak over here to the bottom over here. Okay, that the difference is about 2 ringgit and 41 cents. Okay, so 2 ringgit and 41 cents from the peak of 440. 2.41. Okay, divided by 4.3 is 56%. Okay, so this volume, I'm just going to put a note here. This is 56%. Okay, so this decline is 56%, right? Now here also quite significant, and see the price can also go down significantly, right? So I can also measure here. Again, use the measuring tool. Okay, from this peak over here, oops, from this peak down to over here, the difference is 126. Okay, so from the high of 320. So 126 divided by 1 ringgit, 3 ringgit and 21, that's a 39% fall. Okay, so this fall here is 39%. Okay, so I guess the biggest fall would be this one over here lah. Okay, a 56% fall, right? Eventually, you see the after the 56% fall, the price goes up. But normally also fall at 40%. And I guess this will also be about at least 30% fall. Okay, so this counter is volatile again. By the look of this counter, I'm not sure whether this is fundamentally strong or not. All right, but if you look at the movement, if it's a fundamentally good company, in the long run it should be going higher lah. So it looks it's quite good lah, right? Okay, I don't know about fundamental, but from the price chart, it looks like the company is fundamentally quite good. Okay, but so we only see the big decline here, which is about 56%. Okay, so if you're gonna buy at this price currently, right now, let's say lah, okay, let's say if you bought this particular counter right here at now 4 ringgit and 2 cents. Okay, I'm planning to hold long term. Okay, expect this kind of volatility. 39%, 30% is common. All right, because 30% is common. 56% is the biggest one. So I'm getting myself into the worst case scenario, where if the price do fall 56%, can you still hold or not? All right. And if you have this idea, and some of you have been asking about laddering, right? So laddering is part of a trading strategy for investment. If you have this information, you could have actually made your laddering process better. All right, at least you know what price you'll be looking at before you start laddering again, and all these kind of tools, right? Once you understand the volatility of a particular counter, okay, you can actually make your trading plan better, or investment plan better. All right. So you can go into any counter. Okay, I know you guys have put on quite a number of counter. I cannot go through all of them. I can only go through one because it's already 9:30. But it's very simple, right? You just put up the chart and just find where the biggest fall, calculate the biggest movement, and if it happens before, get ready for it. If the price falls 50%, this is normal. If the price falls 40% from the current level, it is normal. Why? Because it has happened before. All right. Now, the next time I'm going to share with you, let's say if you are trading this particular counter, okay, so I'm just going to show you how to apply the ATR indicator. So here, you just click on this tool, you just look for average true range. Okay, so I already have the average true range here. So you just apply the indicator. Let me just change the settings a little bit. I can see better, right? Okay, so the period here by default is set 14. So I'm just going to change it to 5. All right, 5. That means the 5 days range, 5 days average range. No need to apply so many. So default is 14. Just change that to 5. Okay, so if you change to 5, immediately you can already see what's the ATR calculation. So the ATR calculation for this counter is 0.058, 6 cents. Okay, the average range for this particular counter is about 6 cents. So you take 1.5 multiplied by 6 cents, you get 9 cents. So that means that if I'm going to buy the share and trading for the short term, let's say you want to buy the short term, my stop loss cannot be lower than 9 cents. All right, because if I put anything that's lower than 9 cents, I'll get stopped out easily. So it's a very simple indicator. The indicator is already there. It's already pre-calculated for you. All you need to do is look at the current figure, the current average, which is, in this case, 6 cents. Okay? Okay. I guess I can only share with you guys one, because, again, this is not about strategy to buy or sell. This is extra edge for you to get when you make that trading decision. Okay, so this is where you can download the slides. My colleague will basically post the link, okay, on the comment section in a short while. You can click there, or you can just type in you can type in this link. This is all the slides, right? bit.ly/slides 19 May. Or you can do a QR code scan, okay, in order for you to answer some questions. And then once you have finished answering those questions, you will get an email. So make sure you enter your email correctly. Okay, the link will be provided to you through the email, the link to download the slides. Okay, so if you have the slides and you still can't get what I've been saying today in the past 1.5 hours, do look back at the replay of the video of tonight's session. All right. Okay, with that, if there's no more questions, okay, maybe I take 1 or 2 more questions before I end the session. So if you guys have any sessions, not about counters anymore, right? You can do this yourself. All right. If you don't have a charting tool, you can go to Afin Huang's e-invest website. If you logged in, you will have the charting tool for you to use. Okay. If you have any more questions, I'll just be up for another 5 minutes before I end the session. Right. So any questions about today's session? Okay. So if there is no question, then I'll end the session here tonight. Okay, thank you so much for joining us tonight, and I hope that the session today, and how many of you think the session is beneficial for you today? Please just say yes in the comment section so that I know that you are following me, or you can just give the feedback on the download slide link that you have as well. Okay. So with that, thank you so much, and I'll see you again, and have a good evening, everybody, and happy trading.